There's a famous fable about the origins of chess that goes something like this. The game's inventor introduces it to a king who falls in love with it, and he wants to buy a set. So the inventor asks the king to pay for the chessboard with grains of wheat. He'll start with just one grain on the board's first square and double it on each subsequent square. The number of grains on the last square will be the price the king pays. The king agrees to what he believes will be a meager payout, but soon finds he's made an awful mistake. The amount of grain he'd have to pay would be more than his entire kingdom possessed just halfway through the board. Now, our unfortunate king isn't the only one who can learn a lesson from this experience. Investors can too. The tax you pay on your investments can add up quickly if you don't structure your accounts carefully. But you might keep much of your kingdom if you choose wisely. So let's make sense of the options available. Investing accounts can be broadly divided into two categories: registered and non-registered. Many Canadians use registered accounts to shelter their investments or defer taxes to help maximize their returns over the long term. Two common types of registered plans are registered retirement savings plans, or RRSPs, and tax-free savings accounts, or TFSAs. Here's a quick rundown of each. Investors typically use an RRSP to save for retirement. Any investment gains you make inside an RRSP will be tax deferred until withdrawal, and those contributions are tax deductible, so it may lower the personal income tax you pay for that year. As of 2021, those contributions are capped at 18% of your earned income you report on your tax return, or just under $28,000, whichever comes first. But be aware those figures could change, so make sure to double check with the Canada Revenue Agency. Now, don't worry if you can't reach that limit each year. Any unused contribution room is carried forward, so you'll have the chance to play catch up. Just make sure not to over-contribute. If you exceed the annual limit by $2,000 or more, you'll face a penalty each month until you correct it. When you withdraw funds from an RRSP, you'll be taxed at your marginal tax rate. Most Canadians earn less income during their retirement years than their working years, which puts them in a lower tax bracket. So it makes sense for them to defer paying taxes on their investments. But be warned, you'll lose contribution room and be taxed if you withdraw funds before retirement. Now, there are a handful of exceptions to this rule, such as the home buyer's plan and the lifelong learning plan. Generally though, it's best to leave that money untouched. Your RRSP must be converted into a registered retirement income fund, or RRIF, by the time you turn 71 years old. From there, a gradually increasing percentage of your funds will be withdrawn each year to serve as retirement income. TFSAs work a little differently. They're generally used to save for more immediate financial goals, like buying a car or a vacation. But they're also used to pad out retirement savings as well. TFSAs have more flexible terms than RRSPs. You can open a TFSA once you turn 18 years old and contribute for as long as you live. You'll also be able to withdraw funds anytime without taking a tax hit or losing contribution room. And you may recontribute withdrawn amounts starting on January 1st of the following year. Currently, contributions are capped at $6,000 per year, though that figure has changed before. But like an RRSP, any unused contribution room is carried forward. Any Canadian interest, dividends, capital gains that your investments generate are not considered taxable income inside a TFSA. So any benefits and tax credits that you're eligible for later in life won't be reduced by investment growth in your account. Now, there are a few caveats to keep on your radar. First, there's the monthly penalty if you accidentally go over your total contribution limit. Second, TFSA contributions are not tax deductible. Similarly, you won't be able to claim a tax credit on dividends from Canadian companies if you hold those stocks within a TFSA. For this reason, some investors will instead hold Canadian dividend-paying stocks in a non-registered account once they've run out of contribution room in their RRSP and TFSA. Third, the United States and many other countries do not recognize a TFSA's tax-exempt status. That means you'll need to pay a withholding tax on any dividends you earn from companies domiciled abroad. And you also won't be eligible for a foreign tax credit. That is, of course, unless Canada has worked out some other tax agreement with the countries in which those companies are based. And lastly, the Canada Revenue Agency frowns upon the idea of using a TFSA as a day trading account. It reserves the right to tax your activities if it thinks that's what you're up to, so tread carefully. So that's the skinny on registered accounts. Now here's the scoop on their non-registered counterparts. Investors use non-registered cash and margin accounts to trade financial products like stocks, bonds, mutual funds, and ETFs. With a non-registered account, you're using after-tax earnings to buy and sell securities. And you'll be taxed on any investment income you earn at the end of the fiscal year. That might sound like a raw deal, but there are benefits to non-registered accounts. The most obvious is that there are no limits to contributions, withdrawals, or age eligibility. So non-registered accounts can be a useful tool for Canadians investing beyond their RRSP or TFSA accounts, or if they want to jointly hold assets with another party or invest using a business account. Plus, dividend income from Canadian companies in non-registered accounts can be claimed using federal and provincial dividend tax credits. So that's our overview of the major investing accounts at your disposal. Think of them as complementary tools rather than competing options in your investing toolkit. In fact, many Canadians invest using multiple account types. With a little handiwork, they can offset each other's shortcomings and set a sturdy foundation for your tax strategies. To learn more about investing account types, watch our courses on registered plans and cash and margin. Now that you know how the different accounts are taxed, it's time to learn how various investments are taxed too. For that, check out our lesson, How is Your Portfolio Taxed?